subscribe now and press the bell icon. Never miss an update.
Okay, so our next chapter, chapter 12, is going to be focused on IRA's individual retirement account. And this is again a very important aspect because it can really help in saving a lot of taxes. Whenever we are doing the tax return, we always have to look into this possibility. Can the taxpayer or the spouse or the whatever category we go into, a single taxpayer or a joint taxpayer, can they put money into IRA account? Does it give them any benefit? If yes, how much? Is it really worth putting that money? Because that money is going to be getting locked into the retirement account until they reach certain age. And if it's withdrawn before that, we know what the repercussions are. There could be penalty of up to 10%, it gets taxed, and all the things. Also, there is a limit on how much money we can put into any of the retirement accounts. So even if we are going above that limit, it may lead to certain penalties and all. So we need to be very careful. And it's not like 1 year we put the money, they get benefit. So every year we need to do that. Every year we need to assess basically what is their income. Are they already covered with their employer sponsored some 401k plan or something? If they are not covered, what is their income category falling under? What is that AGI? Can they put money into IRA? Can they get some benefit? Are they eligible for Roth? Before we close on any returns, we always should look into that and see if there is any opportunity to save on any taxes. And even if they are saving on taxes, even if it's getting some benefit out of it, taxpayer may come back and say that, no, I don't want to put money into IRA, which is completely okay. But at least we should let them know that you may have an opportunity to put money into some savings, into retirement savings plan and get a tax break on that. Okay, so that is called IRAs. Whenever we are talking about IRAs, it should suddenly come to our mind. IRA is individual retirement account. It should get registered in our mind. So IRA is a personal saving plan that offset tax advantages to set aside money for retirement. As the name itself is suggesting, it's a retirement account. So obviously the money can be withdrawn only after reaching certain age because retirement is usually linked to certain age, right? So what are the two advantages? One is the deductibility of contribution. The contribution can be deducted from taxable income. Obviously, it will lead to less tax liabilities. Secondly, tax exemption of IRA earnings until they are distributed. So money can keep growing into that account. Today, if you have put in $5,000, after 5 years, it may become $10,000. But as long as the money is not withdrawn from that account, there is no tax impact on that. So an IRA can be set up with most banks, similar saving institutions. We always have to see April 15th is the deadline for IRA for the previous year. So whenever at the time of March, April time, we should do a quick analysis of the tax return before we file their extensions. And if there is any benefit, we need to tell them that, okay, please go ahead and put money into IRA for the previous year, because the window is open until April 18th of the following year. But after that, it's closed. They cannot do it. Then they can put money for the current year. A lot of times these questions are very common. They will ask, oh, where should I open up IRA account? Where should I go? Which bank? What? Any bank they can go to, any brokerage account they can go to, wherever they already have an account, they can talk to the same bank or financial institution, tell them I need an IRA account. It's very, very common. Everybody is going to provide that kind of account. Okay, so let's see what is the taxable compensation. What kind of compensation can be reduced or how can they get benefit? So they should be having one of those compensation, like either wages and salaries, commissions, self-employment, any alimony income and maintenance payments and all. Those are also pre-2019. Because after that, the law has changed. We have gone through that. But what we need to understand is that there has to be some earned income. Okay, there has to be some earned income, then only they'll get benefit. If there is only rental income, interest, dividend income, then it will not be considered as the compensation. Okay. Any individual who receives taxable, I'm sorry, any individual who receives taxable compensation during the year may set up an IRA. That's the only eligibility criteria. And they can also set up for the spouse if they're filing joint returns. Now let's look into what are the type of IRAs. There are 5 kind of individual retirement account, because we always keep talking about what is like, let's put money into traditional, let's do Roth, right? Those are the ones which are very, very common. But then there are other account also, like the retirement annuity plan account. Then there is some employer and employee association trust account. The employer may have that. And SEP, which is simplified employee pension plan, which is saving incentive match plan for employees. SEP and SIMPLE, simple, these are mostly used by self-employed people. If they are not working at some other company, they have their own business and all, they can see what plan is applicable to them. They can put their own money into retirement account, whatever they're earning from the business, plus the business can also match. So if they are putting in 20,000 out of their own pocket, the business can do a match of 10,000 on top of it. I'm just throwing some numbers. So pretty much 30,000 can go into retirement account without any tax impact. And it's a deferred tax account. Okay, we all know what is the meaning of deferred. Later, some point of time, it will become taxable. We are just deferring the tax right now. Why it is important? Because again, this is probably the peak time of their career. They're earning the highest possible income. Maybe it will go down after they're retired. So it's better to take out money once they're retired, because the other income, the earned income and all will reduce by that time. Maybe the tax brackets will go down. They don't have to pay as much taxes as they would be paying now if this was a taxable income. And a lot of planning can be done around that, when to take out money, when not, like what is the income look like, what AGI will they fall under. More complicated is like if those taxpayers, US people, they have moved to any other country outside US, or maybe say India, like a lot of our clients. Then how does it get taxed? How do we report that in India and all? Or what tax bracket will they fall under? There's a lot of planning that can be done. Maybe instead of taking out all money in 1 year, maybe we can plan it that take out, like, maybe over a period of 5 years, 10 years, take out a little bit of money every year, so we can optimize on the tax cost. IRAs are usually fully vested and all. We cannot have like unvested or stock options in IRA and those things. Shareholder status, IRA and Roth IRAs are not permitted as the shareholders. You cannot say that, okay, I have an IRA account will become a shareholder in the company. However, IRA account can hold stocks, that is permitted, but they cannot become the shareholders and all. And this is all possible. A trust can be a shareholder. A LLC can be a shareholder in another LLC. A S corporation can also be a shareholder in another S corporation. C corporation can be a shareholder in another business entity. And so we should not get confused when they are saying that IRA, Roth IRA are not permitted, because they are just not individuals. Any entity can be a shareholder. Let's see what is the contribution. A taxpayer may make contribution each year. The limits may change. So we have to see what is the limit for that particular year. Okay. What are the conditions to qualify to make contribution? Taxpayer must have received compensation. This is an important thing. We saw earlier also, there has to be some compensation. Contributions are not required to be made each year. We can assess our situation. What needs to be done, what not. It's not like once we sign up, we have to do that every year. Contribution must be made by the due date of the return, which is mostly April 18th, because here we are talking about, April 15th, because here we are talking about individuals, not companies. not including extension. So even if we have extension, doesn't mean we get extra time to even to make IRA contribution. Maximum contribution that can be made to any traditional IRA is the lesser of compensation received of $6,000. If the compensation is less than $6,000, there will be a limit. Typically, what we see is most of the people are earning more than that, so they get a full limit of $6,000. Up to $6,000, they'll get full benefit. Again, phase out always happens whenever we are talking about any tax savings or tax exemptions or tax deduction. Phase out needs to be considered. If the income is above certain limit, you will probably not get full benefit of this maximum amount of $6,000 per person that can be contributed to the IRA account. For 401k plan, the limit is more. This year is 20,500 and all. And obviously, if the person is older than 50 years, there's an extra cushion amount for them. Okay. There are certain plans where the limit is 61,000. We will look into those plans. We have certain clients where we have put up those plans. So we have seen that the owners of the companies are putting in $20,500 each, and on top of that, company is also matching 25% of their payroll compensation. So let's say their payroll compensation is $200,000. So 25% of that is 50,000. Then 50,000 plus 20,500 is what they would think of putting in. 20,000 is pretty much employee contribution, 50,000 is employer contribution. So that becomes 50 plus 20 will become 70. But the limit is only 61,000. So again, how do we take full advantage of the limit? How do we structure the payroll so that we are not wasting, any buffer there? Maybe it can be moved to next year. Even the payroll taxes needs to be levied. So all those things we need to take into consideration. Okay, for simple plans, we have few clients, those who are using these plans. And I think Tanya and Purvi, Anurag, you guys were working on one of that client, if you remember. So there the contribution is less. Maximum employee contribution is $14,000. And the employer can also match up to certain amount. That's not very high, like 3 to 4% and all. Then there is SEP plans. There the maximum contribution is 25% of the employee's income, and there is a ceiling. This ceiling will change in 2023. Maybe it will become 65,000. Okay, so we always have to see what is the limit, and that's what the softwares will do. They will tell you, because if you're using 2022 software, it should come up in the software itself that this is the limit. Maximum, you can get so and so much of benefit. So now, why is this important to know? Because a lot of times, preparing tax return is one thing, but doing a proper tax planning is much, much more important. And that's what we will be doing after October 15th, when our deadlines will end. Because we will start looking into 2023 income for all our major clients. We will see what is that they can do, what tax bracket they're falling under, can they put money into IRA, can we run an additional payroll for them before December 31st? Can they have some other strategies? Can employer do a match? Maybe they should change the plan. If they're running simple plan, maybe they should go to their administrator or whatever, that IRA service provider, which can be a brokerage company, and maybe they can put in a request and see if they can change the plan to SEP, so they can get a higher contribution limit. Because once December 31st deadline is crossed, or April 15th, we will not be able to do much. So it's important to know actually the laws. So we at least know that there are certain places where we have some flexibility, and we can see what is best for the client. Especially all the people, those who are running their own businesses, like those who have LLC, S corporations and all, they are the ones, those who have more control over their tax situation. Person who is getting only W-2 income or 1099, they'll anyways not be able to do much, because whatever employer policies are, you need to go with them. So inherited IRAs, yes, a lot of times IRAs can be inherited if there is a death in the family or stuff like that. A person may deduct contribution made to an inherited IRA only if the IRA was inherited from a spouse. So this is important. Only if the spouse has died and the surviving spouse has inherited something, that's the surviving spouse can make a contribution in the deceased spouse IRA account and can also claim a tax benefit. When an IRA is inherited from a person other than a spouse, it cannot be treated as though it was owned by the taxpayer, so maybe they'll not get the deductions and all. What is the spousal IRA limit? That's again $6,000. It's same whether they put money into Roth or traditional IRA. The limit is typically $6,000, $12,000 for the joint filers. I mean $6,000 for each. And if they are above certain age, then they get extra additional $1,000 as an increase in the limit. If the taxpayer has more than one IRA, we have to see what is the total contribution. It's not the per account IRA contribution, right? 6,000 is the limit for 1 year for one person. They may have 5 different IRA accounts where they're putting in $1,000 each or $5,000 each, but we cannot consider that. We have to see the total contribution. Deductible contribution. What is deductible contribution? If neither spouse was covered for any part of the year by an employer retirement plan, the entire contribution may be deducted. If the spouse has not provided any plan, both of them can put money into IRA, they can deduct it. If the taxpayer is not covered, but the spouse is covered by the plan, then the limits are different. Who is the taxpayer whose name comes first on 1040? And then we will put spouse name. It can be anyone. Generally, the person who is earning more, we will put that person name as taxpayer. And there is no such rule that if that one person name has been put up as taxpayer, then we'll have to continue with that person name only for rest of the lives. We can change it. But it's not a rule that if the other spouse has earned more in one particular year, then we change the taxpayer. No, we can continue with the same arrangement, because that really doesn't matter much. If there are some temporary inconsistencies. So if taxpayer is not covered by an employer, but the taxpayer's spouse is, then the taxpayer may still deduct the full amount and all, but there is a limit on AGI. So we have to see what is the range that they need to be under. And if they cross more than 214,000 and all, then the deduction is not allowed. If the taxpayer is covered by a retirement plan at work, the IRA deduction will be phased out. If the taxpayer is covered, then this is the phase out limit for a single individual. If the income is above $78,000, even if they're putting $6,000 in IRA, they'll not get any benefit. And this is an exercise we always do before we finalize the return. That let's go and see if they're getting any IRA benefit. Right? A lot of times in certain files or certain with certain clients, we see they're getting, and some of them are just not getting any benefit at all. So we always look into our IRA sheet and see if there's giving benefit, we'll probably go for it. But why this is happening and all, it's because of the phase out limit given here. Depending upon what category they're falling under, software will do all this calculation and tell you whether there is a advantage coming or deduction coming or not. So if taxpayer did not live with his or her spouse, and if their filing is married filing separately and all, then we have to go with the single phase out limit. Deductible contribution to an IRA have to be made in cash, not in any other property. We cannot say that I'm having this much stock worth $6,000. I'm going to put this stock in a brokerage account and open up an IRA. No. Probably you would want to sell off that stock, get some cash, then put that money into IRA account. It has to be made in cash. Cash meaning not just going and depositing cash. It could be a bank transfer. Most of the time it is bank transfer only. But what they mean to say is it cannot be any other property, even if there is a value attached to that property. Okay. Then again, the modified AGI, if it's not falling in the ranges given above and all, then the deduction will be limited, or it could be reduced, or it could be completely zero. So that's okay. We can go over that later. However, the deduction may not exceed the contribution made. So that is again very, very general to understand. Unlike contribution to traditional IRA, contribution to SEP IRAs are excluded from employees' income rather than deducted from it. So it's just the way it has been reported. In traditional IRA, usually we will see the income coming up, gross income, then there are certain deductions, and then we will get the taxable income. But if it is SEP IRA, they're saying that you don't even count that income in the gross income. Okay, they're excluded from income. So that may have an impact on the AGI and all those things. But these are just different rules. Let's go over rollovers. Rollovers meaning moving the funds from one account to the other account. So obviously, if you are moving a fund from a retirement account to a non-retirement account, there will be tax implications. Because if we are putting funds into retirement account, it's supposed to stay there for a certain period of time. But if we are rolling it over to a different account, it could be a taxable event. But if we are rolling it over to the same kind of retirement account, then all we are doing is we are just changing the bank or the custodial or the brokerage firm. So that will not lead to any taxable event. It will be a tax-free distribution. So there are two types of rollover. Direct. What is a direct rollover? It's a direct transfer of assets from one qualified plan to another plan. What is an indirect rollover? Indirect rollover is where it is, it happens when the taxpayer takes physical possession of the assets. So what the taxpayer is telling to bank that give me the money. If I have 50,000 sitting in IRA account, just give it all back to me, put it in my savings account. Well, that is a taxable event then. But if within 60 days, if the taxpayer is moving the funds back into a qualified account, back into again the same kind of retirement account, then they are exempt from any taxes or penalties and all. That is an indirect rollover, meaning you're using the funds for your personal use, maybe for 30 days, 40 days, 50 days, you want to use it, and then you're putting it back in those accounts. Rollover cannot be deducted. Obviously, it's a rollover. It's not a new contribution. We cannot deduct that. It's just moving funds from one account to the other account. You're not adding anything to your retirement account. It can be taxable or non-taxable based on what we are doing here. Okay. And can anyone tell me what form is issued for rollover? 1099-R. And 1099-R will give us codes, will give us certain boxes will be checked there, which will tell us whether they're taxable or not. Codes will be given. If it's an indirect rollover, direct rollover, the same kind of, or it's an exceptional event, or it's a taxable event. Depending on that, we'll have to understand why the software is giving 10% penalty, or why it is being put up as a taxable income coming up on page 1 of 1040. Okay. If we are making a mistake in inputting that, it could be a complete disaster, because maybe there's a $100,000 taken out, but maybe it's a rollover. But if you don't put the right code, everything will come up as a taxable event. So we need to be very careful what we are inputting there. And we should definitely, whenever we see a 1099-R, we need to ask the client why the money has been withdrawn from a retirement account? What do you intend to do with it? Are you going to put that back in, or did you already put that back in? And all those things we should ask. Okay, so distribution that are not qualified distribution eligible for the rollover. Okay, there could be some distribution that are not qualified, but they're eligible for the rollovers. Required minimum distribution, RMDs. RMDs are very common. So if the person crosses the age of 70 or something, there has to be required minimum distribution that needs to take place from their retirement account. The person may be very much wealthy and all, and he or she may say that, well, I don't need this money there, let it lie there in the 401k account, only retirement account. But as per law, there has to be a required minimum distribution. They have to take a minimum amount out of that account. Hardship distribution, any kind of hardship in the life, or like, any loan, treat it as distribution and all. So they'll be eligible for the rollover. If the if the taxpayer withdraws assets from IRA, rolls over and all, and part of it is tax free and keeps the rest, any of these things can happen. There might be a possibility that ordinary income has to be recognized. Plus, there could be a 10% extra tax on or penalty on premature distributions. Okay, the same property that was received, which is fine. Like if you have money put up into some mutual funds and stocks, and you're moving the same funds and stocks to some other account, it is fine. It is okay. It will not come up as a taxable event. What happens in the case of inherited IRA? Anyone other than the spouse, if they're like getting the IRA, maybe it could be a parent, who has died, and the kid and the children have inherited the IRA. So it is not coming from a spouse. So what happens? The person is not permitted to treat the inherited IRA as his or her own. So the person will not say that, okay, this is my IRA, I'll keep making contribution and I'll keep getting deductions and all. An inherited IRA will generally not have tax assessed until the distributions are received. So if the distributions are lying there only, the person who is inheriting it will not have a taxable situation. Whenever this distribution happens, obviously the tax needs to be paid. But then there are certain other rules also. When the IRA is being inherited, there are certain requirements that within 8 years or 10 years, the money has to be distributed. You cannot just leave it there. We will go through it later. Somewhere it should come up. Okay. The basis of traditional IRA, because of non-deductible contribution, remains with the IRA. So what we need to understand is, when we are putting money into IRA, that contribution to IRA may lead to deductible contribution or non-deductible. Meaning you can take a tax break by putting money into IRA, or sometimes you don't get a tax break. Why? Because your income has crossed certain level, but you still want to put money into IRA. There is no such law forbidding it. Like the IRS is not saying if you're earning more than $500,000, you cannot put money into IRA. Into traditional IRA, I'm talking about. Yes, for Roth, there are certain restrictions. So the person may say, well, fine, it's fine. I'm not getting any benefit. I still want to go ahead and put money into IRA. Let it grow actually there. Let it keep growing there. At least I'm not paying taxes on the growth of that money. So we always, and then when we are doing the rollover and all, we need to pay attention. What was the deductible contribution? What is the non-deductible contribution? Because it may have an impact. The deductible contribution, if it's being distributed prematurely, it will come up as a taxable income. Non-deductible will not come up as taxable because in the first place, we never even got any benefit. Right, by putting money into IRA. We never got any benefit. The name itself suggests it's non-deductible. So there no benefit is given. There is a certain way of reporting it. Who remembers that form? Tanya, do you remember? What form do we generally use for non-deductible contributions? That form has to be there in the tax return. So we can tell the IRS that we made the contribution, but we never got any benefit for that.
8606.
Perfect. Yes, 8606. So that's a requirement. We have to understand if the client says, well, I've put this money into IRA, they're not getting any benefit. We need to make sure all the bases of non-deductible contribution are properly reported in 8606. Why this is important? Because whenever they are taking out money from that account, it should not come up as a taxable event. If we don't report it on Form 8606, how would IRS know? They have no idea. By default, they'll say, oh, you're taking money out of traditional, you pay taxes on it. But why should a person pay tax again? Because that is already post-tax money. It was not pre-tax money. That person never got any benefit. If we don't report it on Form 8606, we are probably like messing it up. Maybe not for that year, maybe not for next 5 years, maybe 10 years down the line it may come and bite us. Okay. So, all right. So here it is. The distribution from inherited IRA has to be distributed by the end of 10th year and all. So within 10 years, we need to make sure they're like all distributing and all. And when transferring an IRA account to a spouse, taxes and penalties may be avoided. Again, this is a very important thing, especially if we have to do some tax planning for our clients, those who are staying in India. Because in India, husbands and wife, they're filing their own personal returns. Which income or which asset to include in whose account, we may see if there is a way we can like do some tax planning around it. Because in US, one spouse can transfer the IRA account to other spouse without paying any taxes and penalties. Should they be doing it? Will they help? Maybe in US it will not help because it's a joint account. Doesn't matter. Joint filing. But in some other country it may help. So again, when we are doing the expat tax and all these things become very important. We need to understand from both angles what's going on. Not just see from one window and say, well, it doesn't matter, you do whatever you want to do. Because US, when it's like it's not going to give you any further benefit or liability. But it may, give a lot of savings in India. So distribution from simple IRA cannot be made once you put money into there for another 2 years. You cannot even distribution, forget it. You cannot even roll over to any other account. Okay, you need to wait for 2 years and all. Okay, let's see collectibles. Generally, IRA is prohibited from investing in collectibles. It could be, I cannot do that. Okay, I have an IRA account. I'm quite fond of, say, some antique cars or jewelries or paintings and all. Those are collectibles, right? Any coins, very precious coins and stuff. So you cannot take that IRA money and start putting in those things. However, an IRA may hold platinum coins, gold, silver and all, that is fine. But collectibles we cannot, because the value of those collectibles is very different, and it's, maybe sometime, maybe 10 years, 15 years down the line, they will allow when it's properly, when they're able to quantify it all, we're properly able to track it and all. Maybe the IRA, maybe like if they open up cryptos and all, maybe people can put money into Bitcoin and Ethereum and other places. But for now, it's definitely not allowed. We'll see, maybe it will change next as people and governments start accepting all these different assets. Okay, so prohibited transaction. Yeah, using your IRA money, you cannot like sell property to it, use it as security for a loan or buy property and all, or borrow money against it and all. You cannot do any of those, because if you do that, then it will be considered as if the money has been withdrawn, and it could be considered as a premature distribution leading to 10% penalties, taxes and all that stuff. So these kind of transactions are prohibited. Here we come. This is an important one. 8606. You will see this form in a lot of our tax files. A taxpayer will have a cost basis in a traditional IRA if any non-deductible contributions were made. Any non-deductible contribution, this is important. So we have to file Form 8606, put up all details there. What was the contribution made in the current year? What was the contribution carried forward from previous years? What is the total contribution at the end of that year? All these things are reported properly in Form 8606. Again, this is important. Why? Because that the backdoor Roth IRA, I'm sure you guys all know about it by now. Backdoor Roth IRA, if you don't report 8606 properly, will not be able to do proper conversion of traditional into Roth IRA using that backdoor entry and all. We know that there is a loophole. Rich people cannot put money into Roth IRA because it's been meant for people with lower income group. And Roth IRA is the best possible way to avoid taxes on a long-term strategy. But it's not possible people to go and put money into Roth IRA directly. So what do? They put money into traditional IRA. Obviously, if they are rich, they don't even get any benefit in traditional IRA. But still they want to go ahead and put money. Why? Because they probably want to convert it into Roth. Why would they want to convert into Roth? Because they're seeing from next 10 years point of view that if I put in 100,000 now, 50,000 now, like over a period of time, obviously 6,000 every year, it may come up to $100,000. That 100,000 can become $150,000. It can grow. You put money into mutual funds or some other, fixed interest bonds and all. It will give some kind of returns. And then when you take it out, nothing is taxable. If that money was originally put into Roth, nothing is taxable. Other versus traditional IRA, if you're taking out the money, $150,000 later, everything comes up as taxable because we got the tax benefit for that earlier. The growth also from 100 to 150,000, if it is increased, the $50,000 of growth, whenever that is being distributed, we need to pay whatever 15%, 20%, 30% taxes on it. But in case of Roth, even the growth is tax-free. And it can lead to big savings when we it's not like in 1 year or 2 years, but it's a continuous practice that the taxpayer should do every year. Slowly the funds increase, slowly after 15, 20 years, 30 years, or whenever it comes to the retirement, and they should start it right from the beginning. We have a lot of young clients young taxpayers as our clients. Those who have just, first year that they received a W-2, second year, we should give this advice to them that you have next 20, 30 years of career ahead of you. Start putting money into this. Let it grow. Okay, that's where we can give some value to our clients rather than just taking their W-2, 1099, punching it in and giving their tax return that, okay, fine, this is your liability, this is your refund, go ahead and sign off and we'll file it. We should think more, how can we help save their money, or how can we help with the proper tax planning. Okay, so recharacterizing is also possible. What is the recharacterizing? Again, transferring from one account to the other. So like from 401k it gets transferred to IRA or something. That's recharacterizing. It's not IRA to IRA, but again it's a 401k to IRA. Both of them have the same kind of characteristics, so it may not come up as a taxable. But traditional to Roth, it may become a taxable event. Okay, let's see what is QCD's charitable contribution. If the money is directly given from IRA to any charity, they may have some tax benefit on it. So the person is not taking that money for himself or herself, and the money is directly going from the retirement account to any kind of IRS approved charitable organization. to qualified charitable organization, then they don't have to show that income, they don't have to show that money as their own income and put it in their tax returns and all, and it can straight away go uh, by surpassing on their taxes. There are certain age limit. The taxpayer has to be at least 70 and half. And so, what is that condition? The person has to be at least 70 and half year in age. So this guy is 75 years, fine. He's making a distribution of $25,000 directly from IRA account to the charitable. Maybe he's instructing the bank that, okay, take the $25,000, put it in this charitable organization. I want to give donation. And the total value of his IRA is $30,000, out of which 25,000 is going there. And it consists of 20,000 of deductible contribution and 10,000 of non-deductible contribution. Okay, so 20,000 of deductible contribution, if he was not giving it to charity, that should come up as a taxable income to him because it was deducted earlier. But since he is giving it to charity, it will not be considered as a taxable income. Why? Because he's giving more than that. He's giving $25,000 to charity. Then what are we left with? 5,000 out of this non-deductible contribution. So that should come up as a taxable income to him. Okay, because if he's taking that distribution, that will not come up as a taxable distribution because this is non-deductible. He never got any benefit earlier. So this money is just given back to him. But he is putting in $25,000 as the charity. So that 20,000 will definitely not be considered as his income, which should have been because it was a deductible earlier. 5,000 will again not be considered because he never got the deduction earlier. But because he's putting that into charity on Schedule A, he can take that as a exemption or as a deduction for charity. We remember, right, on Schedule A, there is a line item, all the donations made. If you make the donation or the Schedule A is itemized deduction. Itemized deduction will reduce the AGI and this is how we come to taxable income. So what they mean to say is there should not be double dipping with both exclusion and deduction. It should not happen. The taxpayer cannot take benefit two times. Okay, that's what we need to, and this is why they've made it complicated, saying 20,000 was deductible, 10,000 was non-deductible. So this is how total value of his IRA is 30,000. Whatever he is giving to charity, it will not get added to his income at all. Why? Because this will become QCD. He is satisfying the condition of at least 70 and half. And the money is not coming to his account. It is directly going from the bank or from the trustees of the IRA to a qualified charitable institution. Okay, so this will be exclusion of income. It is not getting added anywhere in the income. 25,000 we are clear, but his total value is 30,000. So 5,000 is still coming to him. But he will take the remaining 5,000. He will take this charity deduction. Again, don't get confused. Why is getting charity deduction and all? Because we have to see what was deductible, what was not deductible. 20,000 was the only thing which could have added up back to his income because that was a deductible one. But it will not come because he's making much more than 20,000 as his charity. He's doing the contribution of 25,000. So 20,000 has gone out, but his contribution is 25,000. So what about remaining 5,000? He should get benefit of that. Okay, so that's why it will come up on Schedule A. They can take it as an itemized charitable deduction. Because that portion was taxed originally on contribution to IRA. Because What does it mean? It was taxed originally, meaning it was a non-deductible contribution. Whenever he has made that contribution, he did not get tax benefit. So he should get it now. It should not happen that he's getting tax benefit and on top of that he's also claiming charity here. No, that is not allowed. That's what they're saying. The double dipping is not allowed. Any questions here? We'll just wrap it up here now. Okay, we'll just. Any questions on this? This is QCD. Any client who has become more than 70 and a half year of age, and then a lot of these people, they want to make big contributions to the charity and all. How can they do it and all? We can, this is the way out. Okay, if no questions, we'll quickly go. Retirement saving contribution credit, we have seen this earlier also. If the person is putting some money into any retirement saving account, that person may get a credit. Credit meaning the tax liability will be reduced. And this is a table that has been given that under different heads, joint MFJ, HOH, and all other filers, there are certain AGI limit or phase out limit. Depending upon what income bracket you're falling under, your credit could be maximum, it could be 50% of your contribution. If you have put in $5,000 the contribution, the credit could be $2,500. But as your income increases, the credit will go down. Okay, let's go over. Anurag, you can read this 12.2. Let's go over this example. 1 minute is stuck. Okay.
Stephanie, who worked at a retail store, is married and earned $39K in 2022. Stephanie's husband was unemployed in 2022 and did not have any earnings. Stephanie contributed $1,000 to her IRA in 2022. After deducting her IRA contribution, Stephanie adjusted gross income on her joint return is 38K. Stephanie may claim a 50% credit, $500 for her 1,000 IRA contribution.
Right, because their income, they're married filing jointly. The total income is 39,000. She has made $1,000 contribution, so it gets reduced to 38,000. Her AGI is 38,000. Now that 38,000 is falling under what bracket here? It's falling under married filing jointly, less than 41,000. So 50% is the maximum contribution that she can take. So her credit will be $500. Clear, right? This was simple. Okay, let's go over this. Yeah, UBI. UBI is unrelated business income. If there is any unrelated business income, we have seen this concept with a lot of charity and other kind of organizations, trust and all. If there is any unrelated business income coming from an IRA account and all, that has to be put up for taxable. It has to be at least reported properly. Whether there'll be a tax or not, that's a different situation. But it needs to be reported on Form 990T, exempt organization business income tax return. Okay. If IRA has $1,000 or more of unrelated trade or business gross income, and that 990T form has to be filed by April 15th. Okay. So again, this is the same thing what we'll have for charity. If the charity is formed for certain purpose, but they are having they're also they're doing some events and selling of t-shirts or doing some other things where they're getting some business income and all. We'll have to see if that event is conducted. If that event is related to the purpose of the organization. If not, then it could be considered as business income. There could be a tax on that. It needs to be reported properly. The same kind of rule will be applicable for IRA. But then there is a limit. Anything below $1,000, we don't need to worry about. Okay, so we'll stop here now.